Here's a question that messes with most people's heads. How do you go from making $0 in passive income to $8,000 a month? Is that even possible without a lottery ticket or $1 million inheritance? Surprisingly, yes, but it doesn't happen through guessing or luck. It happens through strategy. And the biggest problem is that most people never learn the rules of the game. In this video, I'm breaking down 5 key strategies that unlock serious monthly income from dividend investing, without needing to be rich, lucky, or a financial expert. I'll explain each one in simple terms and show you exactly how it works. Then, using these same strategies, we'll build a real-world portfolio. And at the end, I'll show you and Josh how following this plan with just $7 a day could lead to over $8,500 a month in income, with the portfolio itself growing to nearly $2 million. Before we get into the strategies, let's clear something up, because if you're new to this, you might be wondering, wait, what is a dividend exactly? A dividend is simply a payment that certain companies make to their shareholders, usually every quarter, sometimes monthly. It's the company's way of sharing a piece of its profits with you, just for being an owner. Instead of retaining all the earnings, they distribute some of it to investors as a reward for their trust and loyalty. Now, not every company pays dividends. Some businesses, especially those focused on rapid growth, reinvest all their profits back into expansion, research, or acquisitions. That's common with fast-growing tech companies or startups. However, many well-established companies, such as big names in finance, healthcare, or consumer goods, opt to pay dividends because they generate steady profits and want to retain shareholders for the long term. The amount you receive in dividends depends on 2 things: how many shares you own and how much each share pays. Suppose if a company pays $2 per share each year and you own 100 shares. That's $200 in annual dividend income. To put that into perspective, if the stock trades at $50, then a $2 dividend equals a 4% yield. Collecting that income is a good start, but the real potential of dividend investing goes far beyond just receiving a flat payment each year. The real growth begins when you use strategies that grow those payments, reinvest them, and give time the chance to magnify their results. That's when dividends stop being a small bonus and start becoming a serious income stream that can cover bills, add security, and eventually even replace a paycheck. And it all starts with the most important habit in dividend investing: reinvesting, often called DRIP. Here's how it works. Instead of taking your dividend payout as cash and spending it, a DRIP automatically uses that money to buy more shares of the same stock or fund. It's hands-off. You don't have to log in or click a thing. Just let the system buy more for you. It may sound like a small detail, but over time it makes a massive difference, because every reinvested dividend adds to the number of shares you own, and those extra shares begin generating dividends too. That's where compounding really starts to show its power. To understand why this matters, let's compare what happens with and without reinvestment. Suppose you invest $10,000 in a stock that pays a 4% dividend. In the first year, you collect $400 in dividends. If you simply take that money out as cash every year, your income stays flat at about $400 annually. After 10 years, you've collected $4,000 total in dividends, but your portfolio is still worth about $10,000. You own the same number of shares you started with, and your annual dividend income hasn't grown at all. It's predictable, but it's also stagnant. Let's take that same $10,000 investment in a stock with a 4% dividend yield. The stock price doesn't change. It stays flat just to keep things simple. So every year, that 4% earns you $400 in dividends. Now, if you're reinvesting those dividends instead of taking the cash, here's what starts to happen. In year 1, your $400 dividend buys you more shares. You now own about $10,400 worth of stock. In year 2, those new shares earn dividends too. Your dividend check is now around $416 instead of $400, and that gets reinvested again. Your portfolio's grown to about $10,816. By year 3, you're earning about $432 in dividends. After reinvesting, your total investment is now roughly $11,248. The numbers don't seem huge yet, but look closely. You've gone from $400 a year to over $430 already, just by letting the machine keep turning. And every extra dollar you reinvest keeps stacking more shares onto your total, which means more dividends next year. Give it 5 years and that $10,000 will grow to over $12,200. At year 10, the gap is impossible to ignore. Your investment will grow to about $14,800, while the investor who took dividends as cash is still stuck at $10,000. Fast forward 20 years, and reinvestment pushes the portfolio to around $21,900, more than double the starting value. In the early years, the difference might not look impressive, but as time goes on, the compounding effect multiplies those gains into something truly significant. This is why dividend reinvestment is often described as the foundation of long-term dividend wealth building. Now let's move to the second strategy, dividend growth compounding. This one works differently from reinvestment. With DRIP, your dividends are used to buy more shares, so your income rises because you keep increasing the number of shares you own. With dividend growth, to keep it simple, let's say the number of shares stays the same, but each share starts paying you more over time. In other words, reinvestment means more shares paying the same dividend per share, while dividend growth means the same shares buying a bigger dividend per share. Both strategies boost your income, but they do it in completely different ways. Let me show you how this plays out. Say you invest 10 grand into a company with shares priced at $50 each. That gives you 200 shares. In year one, the company pays $1.50 per share in dividends, so you earn $300. You don't reinvest, you don't buy more, you just hold your 200 shares. Now, this company has a strong history of raising its dividends by 10% every year. In year two, that payout jumps to $1.65 per share. This means your 200 shares will now pay $330. Based on the dividend growth, in year three, the dividend is projected to rise to $1.81 per share, giving you $362 in income. By year five, each share will be paying $2.41, which means your annual dividend income will have grown to $482. The longer you hold, the bigger the impact becomes. By year 10, the dividend is expected to increase to nearly $3.90 per share, and your annual income will be around $780. Compare that to a company that never raises its dividend, where you'd still be stuck at the same $300 a year you started with. That's only 2 of the 5 strategies, and at the end, I'll show you and Josh a real-life portfolio that combines all 5 strategies to turn $7 a day into a portfolio close to $2 million that pays over $8,500 in monthly dividend income. So, we've seen how your income can grow by reinvesting, and we've seen how it grows when companies raise their payouts. But there's still another layer to this, and it's one most investors don't pay enough attention to, because the truth is, dividends are only part of the story. And that's where the third strategy comes in, share price compounding. This is when the actual value of the stock, not just the payout, goes up over time. A lot of solid dividend-paying companies don't just hand you a check every few months, they also steadily grow in price. That means while you're collecting those dividends, your original investment is getting more valuable too. Here's what that can look like. Now, suppose you invest $10,000 into a company, and on average, its stock price grows about 10% per year. What does that actually mean? In the first year, your $10,000 increases to $11,000. After 5 years, it's worth about $16,000. By year 10, it's grown to nearly $26,000. And if you hold for 20 years, that same $10,000 grows into around $67,000. Notice that you didn't add any new money. The growth came entirely from the stock price rising little by little each year. That's compounding at work. Every year you're earning returns not just on your original $10,000, but also on the gains from previous years. Now let's add dividends to the example. Suppose this stock also pays a 3% dividend yield. In the first year, that's $300 in dividends on top of the price growth. If you reinvest those dividends, they buy more shares. Those extra shares also grow in value and pay dividends of their own. By the 10-year mark, instead of having just 26 grand from stock price growth alone, your portfolio could be closer to 30 grand. By 20 years, instead of 67 grand, reinvesting dividends could push your total closer to 80 grand or more. The price growth doesn't just make your portfolio look bigger on paper. If the company also raises its dividend payout per share, your income grows in 2 ways, because you own more shares from reinvestment, and because each share is now worth more and pays more. It's like a double engine driving your wealth forward. And that leads us to the next question. What's the smartest way to keep buying shares over time, especially when prices go up and down? That's where dollar cost averaging comes in. The fourth strategy that makes dividend investing powerful is dollar cost averaging, often called DCA. DCA is simple. Instead of investing in a big chunk of money all at once and hoping you got the timing right, you invest a smaller, consistent amount on a regular schedule, like $100 a month, no matter what the market's doing. Why does this work so well? Because stock prices move up and down constantly, buying regularly means you sometimes buy at a higher price and sometimes at a lower price. Over time, the average price you pay per share evens out, often giving you better results than trying to time the market. Let's walk through the numbers. Suppose you have $1,200 to invest in a stock. If you put it all in at once, when the stock price is $100, you buy exactly 12 shares. That's simple and clean, but it also assumes you bought at just the right price. What if the stock price falls right after you invest? Now let's apply dollar cost averaging. Instead of putting in all $1,200 at once, you invest $100 each month for 12 months. During the year, the stock price doesn't stay fixed. It moves between $80 and $120. Some months, your $100 only buys about 0.8 of a share at $120, while in cheaper months, the same $100 buys 1.25 shares at $80. Month after month, you keep adding shares at different prices. At the end of the year, your $1,200 has bought you about 13.3 shares instead of just 12. Without spending a penny more, you now own more of the company. Why? Because DCA lets you take advantage of the months when the stock was cheaper. By buying consistently, you picked up extra shares at those lower prices, which lowered your average cost per share. This is where the strength of DCA lies. Instead of worrying about whether the market is too high or too low, you stick to a plan and let the market's ups and downs work in your favor. When prices dip, you automatically buy more. When prices rise, you still buy, but fewer shares. Over time, this discipline builds a larger position without the stress of market timing. All the strategies we've talked about so far, reinvestment, dividend growth, share price appreciation, and dollar cost averaging, rely on your actions. You decide whether to reinvest dividends, you choose which companies to own, and you commit to adding money regularly. The final strategy is different. It is time in the market. You don't have to predict the next dip or the next rally. You don't need to hit home runs. You just need to stay in the game. Because time is the thing that turns all those smart little moves into something massive. Time acts like a multiplier. It takes the snowball built by reinvestment, dividend growth, share price appreciation, and steady contributions, and it rolls that snowball down the hill year after year until it becomes massive. The reason time matters so much is that compounding needs space to grow. In the early years, the progress feels slow. Your reinvested dividends might only buy a handful of extra shares, and dividend increases may only add a few extra cents or dollars. But give it 10, 20, or 30 years, and the results accelerate. The biggest mistake people make is trying to time the market instead of giving it time. They try to jump in and out of the market, hoping to buy at the lowest point and sell at the highest. But the truth is, the real reward doesn't come from timing the market. It comes from time in the market. By staying invested, you ensure that you capture both the dividends and the long-term price growth, no matter how bumpy the short-term ride feels. Now that we've covered the strategies, let's bring them into focus with a real-world portfolio built on companies that combine dividend income, consistent growth, and long-term appreciation. We'll start with the foundation, the Schwab US Dividend Equity ETF, ticker SCHD. This ETF pays a 3.8% dividend yield, has grown its dividends by 10.43% per year over the last decade, and its share price has appreciated by 8.75% annually. It's a strong, diversified base, simple, steady, and reliable. Next up is Penske Automotive Group, ticker PAG. The current yield sits at 3.07%, but what makes it shine is its 18.68% average annual dividend growth and 14.02% yearly share price appreciation. If you're looking for long-term growth built on rising payouts, this one checks all the boxes. Then there's Jefferies Financial Group, ticker JEF. Its dividend yield is 2.4%, with a massive 21.45% dividend growth rate over the past 10 years. And the share price has grown by 13.91% a year. It's a sleeper pick with serious compounding potential. Next is AbbVie, ticker ABBV, a healthcare giant known for strong fundamentals. It's paying a 2.97% yield, growing dividends by 12.86% annually, and its stock has gained 15.44% per year. This is a pick for stability with a surprising upside. And finally, we've got Lowe's, ticker LOW. The current dividend yield is 1.87%, but it's backed by a strong 16.97% dividend growth rate and 14.37% share price growth every year. This is one of those stocks that quietly becomes a monster over time. The next step is to figure out your portfolio's overall dividend yield. But since we're keeping things simple with an equal amount invested in each stock, all we need to do is take a simple average. Here's how it works. Take the dividend yield of each stock in your portfolio, add them together, and divide by the number of stocks. So for our 5-stock example, we add up the yields: 3.8% from SCHD, 3.07% from PAG, 2.4% from Jefferies, 2.97% from AbbVie, and 1.87% from Lowe's. That gives us a total of 14.11%. Divide that by 5, which is the number of stocks in our portfolio, and you get a portfolio dividend yield of 2.82%. You can use this same method to figure out the other key metrics too, like your portfolio's dividend growth rate and annual share price appreciation. Using the same 5 stocks, the average dividend growth rate comes out to 16.08%, and the average share price growth is 13.3% per year. Now that we know how strong this portfolio looks on paper, the real question is, what kind of results can you actually expect if you stick with it? We're using a portfolio with a strong dividend yield that blends all 5 strategies, strong dividend growth, and consistent share price appreciation. We're reinvesting every dividend. We're adding a small amount of money every single day, and most importantly, we're giving it time to work. Here's how the projections look. Let's say Josh starts with something small, $7 a day. That's $210 a month. At the end of year 1, Josh will have invested around $2,555. This sets the foundation for future growth. By year 10, his steady daily contributions, combined with compounding, will have built the portfolio to almost $56,000. At this point, dividends will be generating close to $2,000 per year. Fast forward to year 20, and the snowball effect will push the portfolio to $341,000, and annual dividend income will have climbed to roughly $14,000. That's more than $1,000 a month, coming in without him lifting a finger, just from sticking with his $7 daily habit. By year 30, the results will be life-changing. The portfolio balance is projected to be worth nearly $2 million, paying roughly $103,000 in annual dividends, or about $8,500 in monthly dividend income. All from sticking with a $7 a day habit and letting time do the heavy lifting, making sure all 5 strategies reach their destination. Want to know how to turn a one-time $500 investment into a portfolio that pays over $4,000 a month in dividends? Click the video on screen to find out.